What about China? Because, of course, debt accumulation in China, we've had some reasonable inflation figures, but that continues to be a major issue now, doesn't it?
Yeah, China is the biggest debt bubble we've seen. Now, China has followed the route of many emerging economies, virtually all emerging economies, but it's done it to multiples of the size. And all of those previous emerging economies have come down the other side and had some kind of crash. Now, the issue with China is that I have no doubt that they will crash at some point, but the issue is when does that crash happen and how much further they can puff up the economy to forestall that crash.
What do you think about that? Tonight's topic is China. Why? Last night I was watching TV and all three stories had to do with China, one way or the other. They were talking about, you just saw that guy, Vilma Gore, who's some sort of economist, talk about China, the biggest debt bubble ever. I mean, that's big words. Then what I'm going to stick around, what I'm going to share with you is I'm going to stitch a couple of videos at the end of it, the other two videos that I watched, and the first one, the next one up, will be an interview with Roger Montgomery, who also didn't have anything nice to say about the future of China, Chinese economy, Chinese property, and also what that means for Australian property and the economy moving forward, because we know how much we depend on China. He was talking about the latest, obviously the biggest debt bubble ever, and also the futures speculations, and where Chinese speculate not just in property or stock market, they actually do it in the futures market, like trade with bitumen and eggs and glass and cotton and all sorts of things. It's unbelievable. Just don't take my word for it. Watch it and tell me what you think.
Let's drill down a little bit more on China now, because in the last few weeks, as we heard earlier in the show, speculation in trading of all sorts of things Chinese has reached frenzied levels. I'm joined now by fund manager Roger Montgomery. Roger, welcome.
Thanks, Tiffy.
And we first pricked our ears up on this with the trading in rebars, you know, these steel bars that go into reinforced concrete. Yes,
indeed.
And cement in buildings.
Yeah.
How much broader is it, though?
Well, it reached everything, and on April 22nd, when record futures volumes were traded, it was everything from bitumen to eggs to glass and even cotton. In fact, I think 80 million contracts traded that day, and it was the equivalent of $261 billion of contract value, which was more than all the tech stocks on the NASDAQ at the peak of the internet bubble in 2000. It was more than all the equities traded at the peak of the equity boom in China. And I think someone said there was more cotton traded that day, or enough cotton traded that day to make a pair of jeans for every human on the planet, and enough soybeans traded that day to serve 56 billion serves of tofu.
Now, who is trading here? Because we're talking about the futures market, aren't we?
So now remember what's happened. In Australia, Fortescue rallied from $1.85 to $3.60. We've had mining companies all around the world double and triple in price on the belief that the futures trading and the commodity price increases we were seeing in China was reflective of the fact that China was recovering. Now let's drill down, as you said in your introduction. 40% of all the volume traded was in the night market.
Yes.
Now, who's trading the night market? Individual punters who don't want to lose their job during the day if they're gambling on futures.
Punters in Australia, they wouldn't know how to invest in the futures market.
Well, it only takes 40 minutes to open a futures account in China.
And I gather these trades, they were buying and selling, literally, some holding for just 40 minutes or 3 hours.
So the average holding period for a futures contract in China was 3 hours.
Wow.
And the average on the CME, the Chicago Mercantile Exchange, is about 40 hours. Yeah. So this is very short-term trading going on that was driving the commodity prices higher. If you look at the copper price, which is often used as a proxy for global growth, the copper price rose about 10%, and it's still in a downtrend, arguably.
Now we all remember the stock market bubble and burst in China last year. Is it the same as that, or is it different?
Well, what we're seeing, I think, a microcosm of the picture for the world, or a mirror of what's happening in the world. So we've had increased liquidity. Curbs were put on property trading. Curbs were then put on stock market trading. The amount of money you can take out of China has been now limited, but there were no curbs put on futures trading. So as a result, that was where we saw a concentration of speculative fervour. But when asset prices increase and they're supported by liquidity but not supported by fundamental growth drivers, then they mean revert, they come back. And that's what we're going to see in the property market here in Australia. We'll probably see it over the next 3 years in the stock market as well.
Now, the regulators in China have put the brakes on a little bit already in this trading, but also in Australia we've had some response from our banks.
Indeed. So we've seen Westpac and the ANZ say that they have stopped lending to foreign income generated borrowings. They've also just disclosed yesterday or today that they've been duped, and a lot of the declared income is in fact not real. They're falsified accounts. So we're going to see that not only will we see less foreign buying of property in Australia and less of it funded by borrowings, but we'll also see that, as ASIC did last year, cracking down on poor lending practices, that'll need to be tightened up as well. I really do believe that in Australia we're going to see property developers unable to sell all of the supply that's coming out of the ground now over the next 18 months, and they'll be forced to discount what inventory they can't move, or the banks will take possession and discount it for them.
And what does that mean for our property market very briefly?
Well, that means apartment prices will come down. Now, a lot of people tell me, and this is a big mistake, a lot of people say to me that will be confined to apartments. Let's make no mistake, property is priced relatively. If someone sees that a 3-bedroom apartment is cheaper, they're not going to the auction for a 3-bedroom house.
Roger Montgomery will follow it closely. Thank you very much.
Pleasure, Ticky.
Now investors are unsure whether the Chinese economy will turn the corner. Adding to the concerns are moves by China's authorities to curb speculation in commodities markets after last month's massive run-up.
The speculation that's been happening in commodities in China is breathtaking, and that is not a positive development for Australia, because they're trying to curb that, and the last time they tried to curb an area with a lot of speculation was on the stock market.
All this is already playing havoc with the government's key budget forecast for iron ore, opening up another line of attack for the federal opposition.
The forecast on iron ore prices is heroic.
Right now, the free-on-board iron ore price is a little more than $47 a tonne. The budget's forecast of $55 a tonne has raised eyebrows, even if the document's expectations for Chinese growth are in the ballpark.
The growth rate will be fine. Whether a 6.5% growth supports an iron ore price at $55 or lower is a separate question.
It's a question the opposition's happy to answer without hesitation, working off an even more pessimistic iron ore price of $39 a tonne.
Scott Morrison has, with the stroke of a pen, increased projected government revenue by $16 billion. Now that's wishful thinking. As my 11-year-old daughter would say, yeah, right.
That's $16 billion that'll come in handy if Australia wants to retain its top-notch credit rating. Moody's has reaffirmed Australia's AAA rating, but Standard & Poor's is yet to deliver its assessment. In the lead-up to the budget, investment bank Morgan Stanley nominated a government debt-to-GDP ratio of 30% as a key threshold for a possible downgrade, and Australia is creeping closer. An event which, in the eyes of Finance Minister Matthias Cormann, would be more than a threat should there be a change of government.
If Labor was to be successful at the next election, that would be bad for jobs, bad for growth, bad for our AAA credit rating, and very bad for our budget.
Even if Labor isn't successful, the government's own budget forecasts may prove to be the problem.